Oh, we're up. Just give it a minute. Just give it a minute, everyone. Okay, I might kick off. We're just gone 4:01 and there'll be a few people who'll be joining us as we go. But hello, everyone, and welcome. I'm Ian Christie, for those who don't know me, General Manager at Podium Money. Really glad that you could all make it today. Hopefully everyone can hear me okay and the tech is behaving as it should. Firstly, a genuine thank you for carving out some time to be here today. I know everyone's busy. We really do appreciate your attendance. And I think by the end of today's session, you'll be really glad you did. So the budget, yes, every year it rolls around and suddenly everyone's got an opinion. The headlines do go a bit crazy at times and it can be pretty hard work to actually work out what it means for all of us. I know in the last week ourselves, we've had so many questions and so many unanswered questions, to be honest. Whether it be about your mortgage, your savings, your cost of living. That's exactly why we put today together. And we wanted to cut through all the noise and give you something actually useful. To do that, we've brought in someone who is generally one of the best in the country at making sense of all this stuff. I'm not going to steal Petro's thunder though, and I'll let Petro introduce our guest very shortly. But just so everyone is aware, there will be a Q&A section up on the side of the screen you should see. If you want to ask any questions, please post it in the Q&A section, and we won't be able to get through everyone, but we'll try to ask as many questions as we can. With that, I'll hand you over to the Managing Director of Podium Money. Petro, over to you.
Thanks, Ian, and welcome everyone. It's great to see so many of our valued clients and business partners for today's session post last week's federal budget. I have the privilege of introducing our guest speaker. For anyone that doesn't already know him, Warren Hogan is one of Australia's most respected economists. He's currently Chief Economic Advisor at Judo Bank and is widely recognised for his commentary on the Australian economy, from interest rates and inflation to housing and the cost of living pressures. Before joining Judo, Warren was Chief Economist at ANZ, one of Australia's leading economic roles. You may have seen him on the ABC, Sky News, or quoted in the AFR discussing the latest economic developments. What makes Warren especially valuable for today's conversation is his strength and ability to understand and talk in practical terms for everyday Australians. Warren, we're thrilled to have you with us today, and the stage is all yours. Welcome.
Thanks, gents, and thanks everyone for dialing in and taking the time. It's a week later from the budget, so a bit of perspective now. So today I'll try and put even more sort of context around this. It's actually a pretty crazy budget. They really went to town last Tuesday night, and I think all of our heads are spinning a little bit still. So I'm going to try and give you some context about what this means around our economy, what sort of where we're at, what this could mean for where we're going. Although I must say this is about as difficult a time as I've ever seen for forecasting, just because of what's going on in the Middle East, adding a lot of complexity to what was already a pretty tricky situation. And this budget doesn't help, by the way. And then maybe a couple of sort of political perspectives, because the politics is shifting. I think that's why we got this budget. And the best sort of symbol of that is the rise of One Nation in the polls. In terms of the individual measures, and obviously the big ones are around the government sort of seemingly out of the blue deciding to change the fundamental sort of taxation and financing structures that have underpinned retirement savings and wealth creation for a couple of generations of Australia. I can only say so much on that. There's obviously yet to be legislated. There's a lot of detail, and yes, we all have to get our heads around it about what it means for us, our customers, our stakeholders. But we really do need to get as much expert advice as possible. And when it comes to the details, I'm not an accountant or a financial advisor, but the reality is these are some big levers they've pulled, and I'm not sure how wise it is. I mean, as an economist, there's some merit to some of these things, but there's also a cost of change. and we're also in a very uncertain environment. So, look, I'll try and create sort of a story out of all of that, and the best way for me to do that is to show you some pictures. So I'll switch over to the screen. So yeah, the economic context. So let me just, you know, I'm not going to beat around the bush anymore. It's just, it's not worth it. You want to hear my views? I've been doing this for over 30 years, and I don't really have much of a stake in anything other than trying to get a sense of the reality of the situation. And hope we've got a decent economy for my daughters, similar to the one I grew up in. But at the moment, it's not looking great. And part of that is that, we've really got confirmation. I didn't really need it. I was worried about this for a while, but it's really factual now that what this government's been doing for the last 4 years is not working. If indeed the first objective of economic policy is to have a stable and sustainable pathway for the economy. And we just don't, because we never got on top of inflation. There's just a fact to that now. And that was really confirmed prior to the conflict in the Middle East. Back around Australia Day, we got the Q4 CPI on the 28th of January. I mean, I sort of was picking this up from August last year. I mean, I've been worried about this for years, that we just didn't tighten policy up enough to get on top of inflation. And look, the reasons are pretty simple. Our monetary policy is not working, and our government is just spending way too much. This is not a political perspective. The political perspective is, do we want to have a bigger government and do extra stuff with government spending and the taxes that come with that? But this is bigger than anything they thought, because it's been poorly executed, and because they haven't got it on top of inflation, their programs are getting more expensive. So it's just not going well. And I'll go through that in the context of this budget. But in terms of the RBA, they didn't raise rates enough. They tried something that no one else did. They tried this so-called narrow path. I mean, we took the cash rate to 4.35, which funnily enough is right back where it is now, and only going one way at the moment anyway. And, 525, 555, those are the numbers that these other central banks that have got economies similar to ours got to. And look at these rate cuts. Last August, the final rate cut from the RBA, that was their inflation projection. That's a miss. That's a bad forecast. Now, we can all be forgiven for making mistakes, and that's really not the point. The point is that the reforms of the RBA that took place a few years ago are not working. You cannot do monetary policy by committee. It doesn't work. Not unless you're going to stick on there the best and the brightest, and they have not done that, because you need on that committee macroeconomic forecasting experts, and there's literally a handful of them in the country that could go in there and give the RBA any assistance over and above what they've got. So yes, the RBA might have made some missteps with their economic analysis. It's been a tricky few years. The economy is changing. Most economists are struggling. But the reality is it's an impossible task, this setup that the government's given them. But that's not the problem. The problem is government spending, state and federal. It's just out of control. The most important thing we've learnt this year, which the RBA has been telling us for 18 months, which I've entirely agreed with, but we've got to see the realities, is what the speed limit is, what our potential growth rate is, because that's the number that is binding, and it's 2%. We thought it was going to be 2%. We have hard evidence. That's not a matter of opinion anymore. That is factual. So any growth above 2%, which of course is a lot lower than what it used to be for most of my life, my adult life, my career, it's been more like 3.5. So these new realities are not great. Population growth, poor productivity equals 2% potential growth, and you ain't going to change it anytime in the next few years. The supply capacity of the economy, mainly defined as available workers, will not allow us to grow at more than 2% without creating inflation pressure. And that's what we learned in the second half of last year. As soon as that private sector recovery got some momentum, and as soon as consumer spending and then business investment picked up, governments of Australia, of course, did not pull back. And the growth went to 2.6, which for anyone who's been around for a couple of decades or more, 2.6 ain't great. But guess what? It's a boom by the standards of what this economy can handle, and it's creating inflation. That is the single most important thing. And of course, I think that was the starting point for this budget. Back then, end of summer, federal government, they just can't walk away from this reality. What do they got to do? Well, they got to cut spending. Are they going to do it? Of course they're not, because to pivot, to change is to admit error. That's not what politicians do. So they're doubling down. I think the war in Iran has obviously not only supercharged the inflation that we've already had a problem with, maybe gave them some temptation to blame that as opposed to the shortcomings of policy. But I think even Jim Chalmers hasn't got the gall to do that, and he has admitted that there was these existing issues. Emphasis and degree, of course, are important in these things, and I think he's playing it down too much. But the reality is there's also this dynamic with the rise of One Nation. And I think that the political strategy behind this budget seems to be a shift to a much more focus in on underlying cohorts within the economy as opposed to governing and setting policy for the whole country. And that reflects this idea that there's no longer two major parties, but a number of major parties, or you only need 25-30% of the primary vote to win elections. Whatever the case may be, this budget was important, and it was pretty clear what we had to do, in my mind, because the day of the budget, last Tuesday, the NAB survey of business, which has been going on for 30 odd years, confirmed what we're reading in the newspaper. What we're seeing when we walk into a shop is that this inflation that we're seeing come through in the last couple of months is more than just a pickup in petrol prices and diesel prices. It's more than just a direct shock out of the Middle East. It's actually filtering through the whole cost structure of the economy. And that's pretty much the worst case scenario for central banks and for anyone concerned about inflation, because the RBA set the whole inflation target up back in the early 90s on the basis that you can look through a spike in anything. You have a drought, food prices go up. You have a conflict in the Middle East, oil prices go up. Don't respond to that. You watch and see what gets passed through. Well, because of this pre-existing condition, this domestic demand-driven inflation, it looks like it's coming through. And this NAB survey, as you can see, this is sort of, I've standardized it. It's highlighting we're going to get some pretty punchy inflation numbers over the next few months. And really the risk for me, there is a concern that the economy does really start to weaken from here on the back of what's happening in the Middle East. If this thing gets worse, we could tumble into a recession. And in a way, the budget's sort of set for that, which I'm not sure is the central case. And I'm not sure that's the way they should have gone about it. I worry about a boom bust cycle. I worry about us actually navigating this shock, us here in Australia, globally, just like we did the tariffs last year. There were people thinking, including the RBA, that the whole world was going to go into recession on the back of Trump's Liberation Day tariff announcements. Markets fell 15%. They bounced and we got through it. Bottom line is we don't know what's going to happen, and this budget needed to be cautious. So what do I think they needed to do? I won't dwell on this, and I'm happy to share these slides with all this writing. But usually budgets should take a medium to long-term view. But this budget, it needed to take a short-term cyclical view, because we've got an inflation problem, and the government spending and its fiscal policy is part of that problem, and they needed to respond. And what they needed to do was quite simple. Your economy grows at 2, they needed to contain their spending to 2 now. If not, go less. If not, pull back a bit and free some space up for the private sector. That was the objective. And I don't think, as I'm going to go through, they did it. They need to muscle up on the state governments. We've seen the Vic and the WA state budgets prior in the last few weeks, and their spending's growing. It's just, do these people not get it? This is not a matter of opinion. We are pushing this economy to its limit in terms of its capacity, and it's creating inflation, and that only ends badly. There's lots of big picture stuff I won't go through, but they're not addressing, I think, what is going to end up being inevitable. And the reality is the big stuff in our world, our community, our society globally is demographics, labour shortages, and of course, technology, AI. This should be the centerpiece of our long-term planning in this country, and it hardly gets a mention. Because when all your focus is politics, your focus is the short term. Okay, so what do they give us? Budget deficits forever. There's your underlying budget position as a share of GDP. in dollar terms, it didn't move much from where they had in December. So the way you look at a budget is you go, okay, their update in December, the mid-year update, starting point, what's changed since then? What are they doing? How they changed the plan? There's always a plan. There's always a government financial situation, and the budget's just a set piece around updating us on that, mark to market, if you will. Bottom line is, I think for the Treasurer and the government, the most important thing they could do was make sure that the budget deficit didn't get any worse. They didn't need to get it back into balance, and they've basically abandoned that whole idea in this country that has been around in this country for almost 40 years, that we don't just run deficits forever, that we try and repair government finances. We have disciplined government financial management. We don't let government debt get out of control. And that's what we built this modern economy on over 40 years. And they've just chucked that out the door in this term of government, well, this last 4 years. The pandemic pressured it, but they did do a lot of temporary stuff and pulled that back. That worked. But ever since then, it's just been game on, state and federal. And the state governments particularly bear no political opprobrium for mismanaging and overspending, because if the real opprobrium is higher inflation and interest rates, it's the feds who cop all that. So they're the ones who should be having a word with the states and trying to get some leverage on them. Anyway, this need to run a tighter fiscal ship isn't just a short-term cyclical issue about inflation, because as we all know, the cost of money is rising. So there you've got 10-year interest rates out of the market. Government bond yield, the 10-year benchmark cost of money globally is in the US, is the US 10-year. Treasury yield, Treasury note yield, and here in Australia, that's the 10-year government bond yield. And they've obviously increased a lot with the increase in short rates in the last 4 years, but in this last 6 months, they're pushing up. And then in the last 3 months, and we had a little meltdown over the late Friday. It's a little better the last 24 hours. Australian rates are pushing to new highs, as are US long-term rates. And of course, that is the cost of funding these deficits. And that's, I think, it's increasingly clear, and I've had this view for some time, that after 40 years of falling rates, we're now in a long-term upward trajectory. It won't be in a straight line, and we're not going back to 17.5 or whatever we got. We're not even going back to 10. But the point is, the cost of money is going up. So the cost of being financially irresponsible is going up. So they really need to be financially responsible. Japan was the first country to go through this demographic turn about 20 years ago. It hasn't been managed well at all. Their 10-year government bond yield, and this is a country that had negative interest rates and zero inflation for decades, that's all changing. And their 10-year yield is now 2.7%, which sounds low. We're at 5. US is at almost 5. That's the highest 10-year yield in Japan since 1997. So something's shifting. And then, of course, that underlying operational deficit ain't the issue. This government's now indulging, and other previous coalition governments did as well, of course, in these off-budget actions. They're not, they call them investment for policy purposes. I mean, kind of language they use. Anyway, it's more than that. I mean, the university HECS payoff things in there. I mean, yes, snowy hydro disasters in there, a whole bunch of stuff. But we're running big deficits on those off-budget transactions. We're having to spend a lot of money, whereas when this was back in the 90s, there was actually surpluses. But then you get the real position, the so-called headline budget balance, which that reflects the government's call on the economy or call on the savings of Australians and people from overseas. That is 2% of GDP. It's twice the size of the operating deficit. And of course, next financial year, it's going to be $65 billion. So the government, they need to find $65 billion. And the way they find it in the bond market. So they'll get the money away, of course, but the governments of the world are doing this. Is that why long-term interest rates are going up? Anyway, they're probably not all that interested in doing the right thing in the long term. So the table of truth, as the great budget watcher Chris Richardson calls it, basically the quick explanation is these are the forecasts, the operating sort of forecast horizon out to 2930 now. Back in December, the top line was the underlying cash position. So for FY 27, 26, 27, they're expecting 5 months ago a budget deficit of 34 billion. This is the underlying position. And then there's your projections there. So the second line is what I've got, impact of stronger economy, probably a bit misleading. It's basically marking the budget to market or looking at the budget given what's happened in the last 5 months, what's actually happening. And of course, if there is a stronger economy, which there has been, you get more income tax revenues and maybe your costs are up a bit or down a bit, whatever. Anyway, that's the effect of basically reality on your budget since you last provided an update, which of course in the coming financial years, you can see there's an extra 9 billion they got. Then you have the new, what you'd call starting point, and then the new policy announcements, which has been since the last update and on budget night. So when the Treasurer gets up and says, look, we're actually improving the budget, we're banking savings, all this sort of stuff, it's a little tricky. So they're looking at cumulative at the end there. So back in December, cumulative deficits, 195 billion, which is adding up those 4 years, FY 27 on. The better economy, what have you, is going to give a boost to that position of 36.7 billion. And policy adjustments will also boost the budget position by 8.3. So you've got a $46 billion cumulative improvement in the government's budget position in this budget. But let's just have a look at some of the detail. So the first thing is, when you do a plan, if you even include 2930, it's fantasy land. Any budget, any plan, anything that you're doing right now is about the next 12 to 18 months. That's it. Way out in the future, it's a like to have broad light on the hill sort of stuff. And of course, the big kick for this view on the 4-year cumulative is in 2930, when these new taxes really get going, that 19 billion. So that's great. We've got the government taking 19 billion out of us in 2930 because of their new taxes, which I have no idea that's going to hit the economy pretty hard, but I don't care because that's so far away, it's probably not going to happen. The point is, it's the next year that counts. So let's have a look at what happened this current year and next year. The economy, the impact of a strong economy, 24 billion it handed the government, and they've spent 11 of it. If you look at 26, 27 alone, i.e. the budget year, the budget has improved by 9 billion and they spent 6.5. So they haven't banked the savings, they banked some of it, but actually they've spent a lot of new money. The fact is that 9 billion improvement is made up of an $18 billion upside surprise on revenue. Half of its income taxes from individuals, half of its income taxes from companies, and half of its superannuation taxes. And they've then offset that with a $9 billion blowout in their costs, i.e. things like the NDIS and various other programs have ended up being a lot more expensive because, funnily enough, the government, just like anyone else, is going to be impacted by inflation. So look, the reality here is that the government's actually increased spending a heap. Their spending plans for FY 27 in December were 811 billion. They're now 829. So they're 2% and a bit higher than they thought back then. But really, this year, they're now planning for spending to be 788, growing next year to 829. That's a 5.2% increase. You take out inflation, takes it probably just under 3. They're always going to underestimate it. It's always coming in stronger than they expect. They're growing their real spending by 3%. The Treasurer will say, we're growing real spending by 1.1% on average each year over the next 4 years. And that's because they've got really soft numbers in year 2, 3, and 4, which of course, given the inflation's a problem now, that doesn't matter to what's happening in the economy now. They need to tighten up now, and they did not. So the table of truth reveals who is the liar. Okay, so just to sum up, and I've touched on some of this, our fiscal policy is ignoring the main risk. The priority is to get inflation under control, take some pressure off the RBA. We know that inflation's an issue. It was an issue before that war started. We never raised rates enough. We tried an experiment. It failed. Governments of Australia are spending too much. We've got to do something about this, or else we really put ourselves at risk. And the best way to do it would be a bit of fiscal tightening and a bit of monetary tightening. They did not do it. They actually have kept spending at 3 when their economy's potential's 2. They should have, well, I think they should have cut real recurrent spending by 1, investment up, maybe overall keep the thing flat. But they haven't even made an effort. Tax reform that they've announced has just come completely out of the blue. No idea about this, just started it leaked. You know, these are policies they've taken to 2 elections that they did not win. And although, as I said, there's some merit to these things, economists can argue that these changes will create less distortions. I mean, there's a lot of things that you can improve out there. And the reality is 2 things. 1, they're mucking around with long-term structures around taxation and financing that help Australians build wealth. So it's a big thing to muck around with. And they're discreetly just saying no more from now. So they're saying some people can still do it, anyone you can't. So there's a fairness issue there too. Although it would be unfair to take it away from the people who got involved in stuff and didn't know this was going to happen. So it's a pickle, but is it going to produce a lot of economic benefit to the economy? Maybe a bit. Is it going to be disruptive? You bet it is. We all know it's going to be disruptive. But most importantly, they've done it at a time when the economy is very vulnerable. The housing market's dealing with 3 rate hikes and the dark clouds of a war that's still in stalemate, which is, we all know, impacting sentiment in a housing market that's heavily affected by sentiment. The feedback I've had from Melbourne last week is anything over 4 or 5 mil is not trading, and if you want to get something done, it's down 15. Middle of the market's turning over, transactional, hanging in there. But the market is, well, the winter break will probably be a good thing for our res market, because come spring, it's going to be game on to find out where this market's headed. And this tax reform is the last thing that the market needed. It's the last thing the economy needed. It's not bad reform. You could have picked a better time to do it. That's why on budget night, I'm looking at it going, what is this, a budget for 2028? We have got the world's superpower and our closest ally, the US, bombing one of the oldest civilizations in the world, which is right on the biggest source of energy for the world. Anyway, there's been scenarios about this stuff for a few decades now, and it's happening. So maybe don't go and you've had years to do this stuff. Anyway, I mentioned the strong economy has driven all the budget improvement. I mean, look, to cut to the chase on this tax reform, they're dressing it up. It is essentially a tax hike so that they can keep spending and they can show that their budget's not going to get worse. Because if they didn't do the new taxes, the budget deficit would just be going down. And I think that is one metric, no matter how misguided it is, that they're going to want to stick on Twitter and shove out there in the community as a narrative that we're responsible, which is just, fiscal policy is just so hideously complex that it's never that simple, but they know, their marketing people know that they can run with that. And of course, to get that budget not getting worse, that deficit staying at about 30 billion, they needed to put some taxes in. And so I think it's essentially a tax hike dressed up as tax reform. Government spending, I've already mentioned, they're expecting the economy to grow by 1.75% next year. So straight up, we're going to grow at 3, you're going to grow at 1.5. They're not doing anything to fix these deficits despite rising cost of funding, rising rates. It's just not the right budget for this economy. It's a risky budget. I believe it's strategically politically inspired, and I think it's not going to work. So I give it a fail. I've been doing this for 30 years, never given a fail before. So anyway, there's a fail. It's a fail. Okay, so what's this issue with government spending? I showed you, actually I should explain this chart because it's a new chart. So I get my government spending numbers out of the national accounts rather than the budget from the ABS. And this data shows government consumption spending, which of course is their recurrent spending, not investment. I want our governments to invest. That's their job, to invest. It's their recurrent spending, which has got out of control. And you can see here government consumption spending as a share of all consumption spending in the economy. So That would be federal government consumption, state government consumption, and household consumption. It would literally be 75% of the economy. And look what these cougars have been doing. Obviously an upward trend for 40, 50 years, but in the last decade and in the last 4 years, it's just relentless. And that's the pressure that's been put on this economy. It's inflationary. It's more than inflationary. It's changing our society. It's changing our economy. And even if it is for the greater good, do we fully understand the consequences of this? And that's the question I think that needs to be answered. And I don't think, well, the community doesn't. And I don't think even the Treasury economists or the government understand what fire they're playing with here. So federal government spending, recurrent consumption spending, but as a share of GDP, this economy that we built, the Bob Hawke, Paul Keating, John Howard, all those reforms, Peter Costello, that we bedded down and delivered us one of the best economies in the world, was based on a range of things like globalization, free trade, rule of law, blah, 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 and disciplined government financial management. And that meant federal government consumption spending remained a stable proportion of the overall economy at around 7.5% on this measure. And as you can see, it's just completely been blown out of the water in the last 10 years. Now, you can argue that demographics, the need to look after more older Australians has played a role. Obviously, the NDIS and looking after a broader range of Australians in need has played a role. But at some stage, this cannot go to 100. You've got to cool your jets at some stage. And of course, after the pandemic, when they really good policy of temporary help, probably overcooked it, but all easy in hindsight, but they got it out. That was the time when they got it out. It's fallen back again 4 years ago that we needed to stop and go, wait a minute, where are we at? What are we doing? What's this going to cost? I mean, it's not just the feds, all state level, it's all levels of government, state, local, federal, is doing the same thing. And as you can see from this chart on the right, we are seeing the biggest structural shift in the presence of government in our economy since the introduction of the welfare state in the late 60s and early 70s. Wasn't a great decade for the macroeconomy after that. And really, that was introducing just a high level of payments for those in need. This is for people in need, I'm sure, a little bit of mismanagement and corruption around the edges, but it's actually funding the private sector. It's not paying an unemployed person or paying a pension. It's actually paying a private operator to provide a service. And this is where we've let the barbarians at the gate threaten the public finances of this country, because the government actually is not directly in control of all of these programs. And they're price takers. They provide aged care, child care, disability care, and these private providers, in a world of inflation too, quite rightly will say, well, it's costing us more to do it, and then they'll ask the government for a check, hence why they can't keep their costs under control. This can't keep going on, and this is why inflation is so diabolical, and the combination of big government spending and inflation is putting us into a pretty bad space, basically. You can see here, this is the annual growth in government consumption spending, excluding defence, and then household consumption. And look, we had small government in the 60s. We constantly sort of gave a little bit more resource to federal government because with a bit of extra money, they were able to do a lot of good things. But it's just sort of got out of control in the last decade. And these other measures around defence spending and around investment, they haven't moved anything like the consumption or recurrent spending. So this is the thing that's pressuring this economy. This is the thing that people, other economists, markets lose sight of when their time horizons the next 3 months, next year. This is the big structural shift, and it's happening at a time of some other big stuff like the demographic shift, like AI and new technologies that are going to change this place. And it's this budget doesn't make things better, in my view. It's risking making things worse. So just to finish this bit off, and I'll get into the economy, is you can say, people will come back and then say to me, well, the ALP went to an election and said, we're going to do this, and the Australian people voted them in. So, whatever, you got to do it. Well, sure, I'm respectful of that democratic process. And look, I think the Australian people understand that if we're going to have a bigger provision of services from the government through the care economy, various care economy channels, that they're going to have to pay higher taxes. So I'll give the Australian people that. Did they get that? And that's what they voted for. I actually doubt that. But anyway, let's run with that. That's just the starting point of the costs. And this is what economists are for. And this is where a lot of economists have let this country down. The first thing is there's a lot of people who look at Australia and go, our budget deficits are small compared to the rest of the world. Our debt's small compared to the rest of the world. So we've got plenty of scope to go out and spend. Well, maybe. But we built an economy based on disciplined government financial management and low government and debt. And what did we get at the end of it? The world's biggest household debt. So if you're going to go and change one, i.e. if you're going to say, well, we're not going to do that government financial discipline anymore, we're just going to have deficits and we're going to run debt, expect something to happen on the other side of the equation. Because this chart with countries all around the world shows you that basically there's a mix, a sustainable mix. So at one end, you've got us and Switzerland and Canada and Netherlands that has low or lowish government debt and high household debt. And then at the other end of the spectrum, well, Japan's the outlier with massive government debt and low household debt, but that's the general equation. So they keep going down this track. We're going to be putting pressure on that household debt, which will probably happen through higher interest rates, hopefully not through availability of credit. But actually, that's not even the full cost. In a capacity-constrained economy, as I alluded to at the beginning, when you've got 2% annual growth up your sleeve before you create inflation, the government's fair share of that is 2%. And actually, if they were real leaders looking to embrace the best interests of the whole community going forward, they would maybe free up some space after growing at 3 or 4% for the last decade for the private sector to flourish. But they're not even doing that. They're growing at 3 still. So they're just not only taking away, running up debt, threatening our financial structures that have been in place for 40, 50 years, but of course they're denying the private sector capacity. And of course, if that ends up with the RBA raising rates, it's the private sector that pays for that. So I don't like this budget. I don't like this government's economic strategy. And I thought they'd learn. I've been warning about this for a number of years. We got hard evidence that it ain't working over the summer. The RBA's pivoted. They've done 3 rate hikes, reversed all of the cuts from last year. So what happens next? I'll skip this. Basically, the whole of government is about actually taxing the productive to fund the unproductive, and it's a judgment call. We need roads and hospitals and police, and there's a whole bunch of other things we need, including a dose of social welfare for a fair and just society. But it's a payoff, especially when you're changing it. And quite frankly, we've overcooked it. We're taking too much and we're taxing too much of the productive, and we're forking out too much to the unproductive. It's kind of cost us more than anyone thinks, and we're starting to get the evidence of that. So where's the economy at? Well, unfortunately, we're pretty badly exposed to this shock because we did not get inflation under control. So the OECD is the rich countries of the world. They had inflation under control. Well, they had stabilized it at around 2.5 to 3. They probably wanted it at 2, but look, at least it was stable. Here in Australia, never any stability. It fell and then it just started rising again. And of course, that domestic demand-driven inflation is going to interact with this global supply shock, and we don't fully understand it because we haven't seen it in the modern context anyway. But the thing you look for with a supply shock is not, as I said, the petrol price spike, it's the flow through. And when you've already got business cost pressures punching up constantly year in, year out for the last 3 years, rather than businesses seeing a 30% increase in energy bills and going, look, we'll just wait before we change our prices, it might come down. They've gone, our prices have been going up and our costs have been going up and we need to pass this on. Headline, energy up, we'll take that as a reason. And it's actually more than that. Everyone's bloody transport costs went up straight away. The first week of March, it just came straight in. So that so-called second round effect, that pass-through is happening like a lightning bolt in this economy, and it won't be like that in other economies. Won't be good in other economies because we are in an inflationary world. But if this had happened 15 years ago, we wouldn't have seen this. So this is the issue. And that NAB survey said, yep, it's happening. We all know it's happening. We all know when we walk into the shops what's gone on in the last 2 months. We're right back to where we were in 2022. And this government's delivered this budget. They're going to pay a price for this. The only way this is going to work for them is if the economy just topples into a recession in the next few months because of what's going on in the Middle East, which at the moment we're not seeing. Otherwise, if we get through this, we've got one hell of an inflation problem to deal with. The housing market turnover, this is industry data. It's probably a few weeks out of date now, but turnover, the markets, the pipeline's drying up, sentiment's damaged. I mean, the picture I've been painted in by people in a variety of East Coast cities in the last few weeks is that top end stopped. If you want to trade, it's not good. Middle still transacting, but what's that pipeline looking like? Bottom end unclear, still some stuff happening, maybe even some price rises in some markets. But sentiment is heavily affected by the multiple rate hikes, the war. And I don't think this budget helps. If house prices do not move at all in the next 12 months, that's probably a good outcome. Because we're throwing up risks here with what we're doing with the budget, with the risk factors sitting in the global economy, and the fact that the budget's basically just throwing it to the RBA. I mean, the political strategy here seems to be, look, we're not going to tighten up. RBA, they'll end up having to raise rates, and we'll just blame them for all the pain and suffering out there, which, you know what, I don't reckon the Australian people are going to get it. But, watch Twitter, watch the people who are supporting the government blame the RBA. The RBA's got to be careful. They tiptoed around this for the last few years. They've got to now start sticking up for themselves. This is best kind of defense is offense, and it's time. So there's a speech that I haven't actually read, and we'll see. But the next little while, the RBA is not, they are being forced into this by, that Victorian state budget was ridiculous, the WA state budget. I'm pretty convinced the New South Wales budget will be more sensible, but still, it's not going to offset what's already happened. So the housing market is going to really be under some pressure in the short term. I don't know that these tax changes are going to trigger a major shift in activity, but we're really not going to know till spring. RBA, I mean, I've got a couple more rate hikes in there. I don't know what's going to happen. The cash rate's way too low. I mean, we saw these other countries take their cash rate to 5.5. We went to 4.35. Clearly, we stuffed that up. So we got to be thinking at least 5. I mean, if I was the RBA, especially after that budget, I'd do it at the next meeting. Probably isn't that smarter idea, but I'd do at least 40 or 50 of it. Just get that rate somewhere even close to where it needs to be. The fact of the matter is the real interest rate, that is the RBA cash rate, you pick your rate, mortgage rate, whatever, but the interest rate minus inflation is not high enough. In terms of the RBA cash rate, it probably needs to go to 2. It never got anywhere near it. At the moment, it's not even at 1. So we're not debating whether they need to go once or twice. Every fundamental economic model tells you it's between, twice and 6 times. And the best chance they've got of not going 6 times is to go hard and early. And given that the market's already under pressure, maybe, will you suddenly trigger a whole financial catastrophe? Well, I don't think so, because the key here is that employment is holding up because of the demographic shift. The RBA talks about locking in the employment gains of the pandemic. They're not locking in anything. Demographics is locking that in. That's why it was misguided, this sort of shift and balancing. They got to kill inflation. History shows for thousands of years, every culture around the world, inflation is going to get you. Do not underestimate it. And we are now living, breathing proof of this. So how does the RBA go? I don't know, but they should hike 40 in June. The market's currently pricing in 4 basis points. What's that? A 15% chance of a 25. I don't know what they're going to do. I don't know. If the economy does suddenly start to get denied energy because we've used up all of our global inventories of oil and the Strait of Hormuz is not open, and suddenly we can't, run fishing fleets and trains and trucks, sure, you're not going to raise rates because the economy is going to stop. But in the absence of that, if the economy gets through it, then they might have to raise rates. And as I said, my biggest fear is exactly what happened in this country in the late 1980s, and that is they just had to keep raising rates and raising rates and raising rates until it got to 7.5%, and we created a financial crisis. It wiped out Westpac and almost ANZ in terms of their capital. We recovered that just. Unemployment doubled. Now I don't think unemployment's going to double. The point and the argument I've made the whole time, 24 and now, is you're willing to take a bit now to take the risk out of a lot later, whether you call it rate hikes, whether you call it financial distress, but I think it's pretty clear. There's no such thing as a free lunch. The piper will be paid, and it's about judging how you get through it. That's not how our politics is running at the moment. It's not how that budget was put together. And I think the government's made a severe miscalculation on this. But the reality is, I have a less strong view than probably ever. Certainly what I generally like to have. But my following of what's going on is more important than ever, because we've just got to watch how things play out and obviously reform up our views on what's the likely outcome. Is it time to get defensive? Yes. Is it time to panic? No. Is it time to be aggressive? Maybe in circumstances, but right now is actually time to watch and understand how the world's playing out. So just quickly, there's your job vacancies. That's your labour shortages. We're at the start of a 20-year cycle. This is going to get worse every year. That's why AI is here to save the day. Anyone telling you, oh, it's going to disrupt jobs and lose jobs? Well, yes, it is. Then there's nothing you can do about it. So why don't we try and retrain our people to do the jobs where we've got thousands of vacancies? And it's not just in aged care or childcare or teaching. It's in construction, hospitality, defence, police, you name it, everywhere. The only industry we don't have structural job vacancies, labour shortages, is banking and insurance. So far, we've been offsetting these demographic trends with labour force participation, but even that's now starting to run out of steam. So this is going to start biting, and it gets worse every year. Every year it gets worse. And if we don't face this reality, if we don't start reorientating our labour force, if we don't start embracing this technology, our incomes and our living standards are going to continue to go down. And we built one of the best economies in the world. An economy that Bob Hawke and Paul Keating and John Howard and Peter Costello bedded down is one of the best economies the world's ever seen. It was like Oscar Piastri's race car. But the problem is the McLaren mechanics aren't working on the car anymore. The mob up the road here are doing it, and Oscar doesn't want to get in the car because his brakes might not work when he's going into a corner at 320 kilometers an hour. He doesn't want to up in the wall. But that's our economy. It is a wealth generating, well functioning machine, and it needs to be respected and looked after, and it's not, quite frankly. But our future is bright. It's no different to anything for the last 50 years, indeed the last 200. And even if one nation did somehow manage to get into government, which I don't think any of us can fully comprehend that one, but anyway, they're not going to cut our immigration to zero. Their plan is half. And of course, in reality, when they get in the government, that'll be half that. So, the fact is, Australia is going to continue to have immigration. We've got to manage it, obviously. And I think the way that the coalition's linking it to housing is interesting. I don't fully understand it, but we have to cool our jets at the moment. The labour shortage issue isn't solved by immigration. It can solve an individual firm's problem, but you bring someone in and they might do a job, fill that labour shortage, but they need a house and a road and a Bunnings and a Coles. The only way you fix it is through technology. We get the immigration because we've got that potential. We're a young society. If our population density was the average of the world, we'd have 100 million people. And what that tells you is one day Australia will have 100 million people. It's just whether it's 50, 100, 200 years away, I don't know. And it is immigration. I don't like the way our fertility rate's going down, but that's a global phenomenon. But anyway, the prospects are good, and we actually have a good economy. We are building, we are investing for the future, whether it's in infrastructure, whether it's in data centers. And the house building, it does need to pick up, but it's still picking up. There's still stuff going on. We have actually got a construction boom going on. The problem we've got is, well, I think we need to do an audit of all the national infrastructure projects, and we need to find some balance between the construction resources that go to infrastructure versus going to res, maybe non-res, data centers, what have you. I.e., we need a national audit. I don't think you just get government out of the way. I don't believe in small government. I believe in good government, and government playing a constructive, supportive role, which, funnily enough, is pretty much what Australian governments have been, by and large, doing for the last however many decades. It just isn't that way now. And what we need to see is a bit smarter government, and we're not getting that. So just a couple of last comments. This is the population density. I won't bore you with that. But on the right here is dwelling commencements. It's an annual average across the states. There is going to be a competition between states. In a world of labour shortages, where states want to invest. The construction sectors are so important to infrastructure, to housing. The thing is, to attract workers, you need affordable housing. You need to build houses. And funnily enough, the two growth states, WA and Queensland, they've got some work to do on this front. No wonder the house prices are going up so much. But New South Wales and Vic are actually, they're building houses. I mean, this doesn't quite capture it, but New South Wales, which I'll read as Sydney, they've seen a big pickup in dwelling commencements in the last 6 months. And that's, I'm sure, got to do with a lot of this infrastructure now getting better down in the private sector going, wow, we can build some houses there because there's a great road that gets you there, et cetera, et cetera. So, if anything, the construction side, the long-term outlook for this place is no different, is good. And this technology is amazing. So just to finish up, in terms of small business in general, this is our global perspectives. These are similar economies, corporate balance sheets. I don't know what's going on in Canada, so we'll chuck that away. But everyone else, the corporate sector, the business sector has been looking after its balance sheets for 30 years. 1980s, different story. But now households have run up debt. Governments have run up debt. Now, I don't think there's going to be a major problem over there, hopefully. But the thing is, corporate balance sheets are in good shape, and SME balance sheets actually around the world are in surprisingly good shape. That's interest cover ratio around the world. And what that chart tells you is after the massive lift in rates around the world in the last few years, we've adjusted. And of course, the business community is actually going to be absolutely critical to this country's future in the next 10 years in terms of using that balance sheet capacity to lead an investment in infrastructure, technology, homes, the whole lot. The consumer is going to be more conservative, consolidating. Demographics dictates that. High household debt dictates that. So it's the business community which will lead the way, and the governments need to facilitate that. But that just doesn't seem the way these guys think in Canberra at the moment. So I'll leave it at that. I'm not sure if I actually had a conclusion there. I think I just delivered a book worth of information to you in my 50 minutes.
Warren, that was fascinating, actually. For myself, it consolidated my thoughts, really, and it's where we're heading into an environment where it's going to be pretty tough and disruptive ahead of us. And there's been a lot of smoke and mirrors which have been presented by the government, I guess, was my take out of that. We do have a couple of questions, and I could quickly ask those of you. We've got a few minutes left. This is from Gurge from Canberra. Hi, Warren. Do you think all these issues, both Australian and global, stem from an economic theology of debt as a percentage of GDP that has failed?
No, I don't think it's that simple. I mean, obviously, when we get ourselves into trouble with debt, that's an issue. I mean, debt is essentially a reflection of how much savings is in the economy that needs to be recycled into investment. That's, what a modern economy is. For 250 years, that's what we worked out. Oh, banking system, we'll take surplus from here and give it to someone who's an entrepreneur who wants to invest. Funnily enough, we really kicked off civilization as we know it. The point we got to in the 80s and in the GFC was the missing piece was actually not the savings and investment bit. Demographics dictates that, and there is an issue with demographics on that front. But what we missed was the regulation of the banks, the credit creation process that sat between that. But we now regulate the banks to within an inch of their life. I mean, private credit might have a few issues in the next few years, but look, I'm not sure that we're recklessly mismanaging debt. Debt comes from the way the system works, from savers, and therefore them having money they want to deploy. So, look, I think we probably have a problem of governments doing too much, would be more my issue. And then in our case, yes, our government probably running up debt too quickly when it could otherwise be a little bit more conservative. I think they've got this sort of grand agenda that's some fantasy about what Australia could be that's more relevant to them than the realities of the world we're facing. Governments are put in place to manage the situation, as we all are. Yes, we can come up with a business plan, but if the world's changing and the business is under pressure, you've got to respond to it. And in fact, we've got one of the biggest transformations of society happening because of demographics and technology. That should be their focus, not coming up with some grand plan around care economies and this, that, and the other. So, look, debt's an issue for government in this country. Let's hope it's not too big an issue. But the only time debt's really a problem outside of when the banking system's not well regulated is when there's a sudden shift in either savings or investment, which causes interest rates to move a lot, and suddenly people have got a cost of debt that they weren't used to. Now, we've just done a real life stress test in the last 4 years, one hell of a stress test with 400 basis points of rate hikes into this economy with floating rate debt everywhere. So, yeah, look, I'm worried about the bumpy road ahead, so to speak. But yeah, I don't think we've got a system that's not working or anything. I mean, I think it's part of what makes us successful is that we can take the money of those who've got savings and get it to those who've got ideas and energy.
Thank you, Gurj. That's probably an answer that you weren't expecting. It was a long one. And the
No
final
such
one,
thing as a silly question, but there is such thing as a long-winded answer.
and the last one, Warren, and it's been fantastic. This is from Mark. With all this financial pressure, how will the financial groups fare? Banking, in terms of banking issue and the banking crisis.
Yeah, look, I'm not concerned about a banking crisis. I mean, look, I think, you know, people have asked about where the pressure point, you know, if the government does start to, you know, grow in a way or is growing in a way that puts pressure on household debt, is that I implied in that. You know, it'll be through rates. I don't think there's going to be a sudden cut in availability of credit. My observation is there's money coming out of our ears. It's deploying credit that's been the hard thing for the last 5-10 years. I mean, that hasn't changed. That'll tighten up as the baby boomers start drawing down on their savings for sure. The first baby boomer turns 80 in 2026. That's a big deal, but that'll take years to show up. But I think the banks, the thing that worries me is the 5% deposit. That's going to have sucked in some people who are very marginal. And the world's changed radically since that came into operation last October. So there's a risk factor there for me. But for me, it's private credit where it's not regulated. But in this country, private credit is tiny. So there might be an issue in private credit, but it's not going to wreck the Australian economy. Europe and America, that could be different. But let's hope not. But yeah, I'm not waiting for an explosive banking crisis. But if we keep going the way we're going with government fiscal policy, maybe down 5 years down the track we could be, but at the moment I'm not that concerned. But yes, we're going to have some trickier times ahead and probably a higher cost of money and a little bit less demand for mortgages. But still, we've got a growing population and people want houses.
Well, thank you, Warren.
Just before we finish up, and just one question, Warren, before we finish up, just your thoughts on the property market, sort of in the medium term, as a whole, whether obviously the investment side might be slightly impacted with the new changes in the budget, but how do you see the property market as a whole in the next sort of 3 to 5 years, in your opinion?
Yeah, I just want to be careful. My instinct, you know, obviously I've got this macro focus, and there's a pretty punchy story there, and I'm just reluctant to get these big changes that they're putting forward and run them through too much, because A, they may not get through, and B, Angus Taylor's suddenly looking a little bit better now, and he said he's going to get rid of them. So look, I think we got a shortage of housing. We know that, you know, how property investment is not something that's just unique to Australia. This is a human thing. So look, I mean, we might have some bumpiness. That's why I said the spring is important. That's why I'd prefer the RBA to do 100 points of tightening in the next 3 months than risk dragging out 300 points or 200 points over the next 2 years. It all depends on how it plays. But the reality is the property market is still as good an investment as ever it is. We may have a bit of a short-term, you know, peak. Like I said, 0 price increase over the next year, and that's probably not a bad outcome. But, you know, 20% down in Australian average house prices from here takes you back to where we were 3 years ago. In terms of the demand for credit and the amount of mortgages being written, look, the thing that worries me is if this tax changes just happen, like they said, my read is, well, I'm going to get divorced and put my wife into another owner-occupier tax-free property and continue my marriage as a divorcee, because that's the last tax dodge, is your own home. So I'm not actually going to divorce my wife. Did you get what I was trying to get at there? Anyway, or I'll have a 16-bedroom house. The point is, it could create some real distortions around that. But if they want to tax housing, your family home with capital gains, that's fine, but just let us have the mortgage payments off our income tax. And let's see how that one plays out. I mean, they're playing with some big levers. I think they should. I got a feeling they might have to back right off everything. That'll be really humiliating. But anyway, it's too early to be too prescriptive. Let's just watch.
Looks like divorce
Thank
rates
you.
are on the way up.
I reckon.
that.
Well,
Yep.
technical
So-
divorce. There could be more love in the world, a bit of, multi-family living.
Warren, we've just come up to on an hour and you've done an exceptional job, very insightful. On behalf of Podium, thank you so much for your time, very much appreciated. And for all of those online, thank you for your time as well. Have a great day, everyone, and we'll all speak soon. Thank you.
Fantastic.
Thank you.
Thanks, everyone.
Cheers, mate.
Thanks for having me.
That went pretty